Well, everyone is talking about it. It's on everyone's hot list. We're talking about silver. Now, silver is not moving higher because there was suddenly less silver in the ground. It's moving higher because the market has quietly crossed a line where demand is no longer optional and supply is no longer flexible. Now, most commentary stops at the deficit narrative. Production is lagging demand. End of story, right? No. That explanation is incomplete and, frankly, it's a little lazy. The more important shift happening beneath the surface is who now controls silver demand and how little discretion they actually have. Now, silver has transitioned from something cyclical into something embedded. It now sits inside the infrastructure of the global economy. It's inside solar panels, grid expansion, electric vehicles, defense systems, and high-performance computing. Now, these are not discretionary uses. These sectors don't pause their consumption because prices rise. They absorb higher costs because silver is not easily replaced without sacrificing efficiency, performance, or reliability. And that is supported by the latest data. In 2024, industrial demand for silver reached a record 680.5 million ounces, the highest level ever recorded and the fourth consecutive annual record. That demand was driven by structural gains in the green economy, grid infrastructure, vehicle electrification, and by artificial intelligence-related uses, which boosted growth in consumer electronic shipments. Even though total silver demand fell slightly, driven by weaker investment and softer silverware and photographic demand, the industrial segment continued to expand. Now that tells you what is really pulling this market. Meanwhile, the supply side of silver remains structurally rigid. Roughly 2/3 of global production still comes as a byproduct of copper, of lead, and zinc mining. That means silver supply doesn't respond to rising prices the way most investors assume. When prices go up, miners don't suddenly produce more silver. They produce more of whatever primary metal they're chasing, if at all. This is one of the most misunderstood aspects of the silver market. Higher prices don't equal faster supply. New primary silver projects take years to permit, finance, and also to build. Now, recycling helps at the margin, but it doesn't scale fast enough to offset structural deficits. The market now finds itself in a situation where price is doing the work of rationing demand. But demand refuses to be rationed, and that's the tension. And here's another critical point. This isn't just about economics, it's about strategic behavior. Countries are increasingly holding metals as national inputs rather than trade goods. So refined silver is being prioritized for domestic manufacturing, energy security, and technological independence. That kind of shift doesn't show up as a simple supply figure. It shows up as access risk, and markets are notoriously slow to price access risk until it is already baked into inventories and contracts. So according to the Silver Institute, the global silver market recorded a fourth consecutive annual deficit in 2024 with a total deficit of about 148.9 million ounces. Now, over the four-year period from 2021 through to 2024, the combined deficit reached roughly 678 million ounces, the equivalent of nearly 10 months of global mine supply in a single year. That's not a short-term imbalance, that's structural scarcity in growth sectors that don't slow down when prices rise. So now silver behaves less like a precious metal tied to emotion and more like a constrained industrial asset with monetary side effects. It reacts to growth, to policy decisions, to electrification timelines, to digital transformation and geopolitical positioning all at once. That combination is rare. And when it appears, pricing tends to be unstable until a new equilibrium is discovered. So the real question for investors is not whether silver demand exceeded production this year or last year. The real question is whether the global economy has already committed itself to a level of silver consumption that cannot be reversed without slowing electrification, data expansion, and strategic manufacturing goals. Because if that answer is a yes, then silver is not in a rally, it's in a structural reevaluation. And the question that should linger longer after the price charts are closed is this: What does silver get priced at in a world where access matters more than cost? Scarcity is shaped by policy, and demand is locked in long before supply can respond. This is the silver conversation worth paying attention to. This has been your Market Knowledge. I'm Lyndsay Malchuk. Stay tuned because I believe this year there's more to this story coming.